Hello and welcome to the week ahead video with me, David Madden. Now, before we take a look at the major events of next week, let's take a look at the major events of the week just gone. This here is the US30, the Dow Jones. You can see here that it's been in a strong upward trend recently. Earlier this week, the market hit its highest level. It set a new all-time high, which really underlines how strong the recent rally has been. We closed higher on Thursday night in the US, thanks to a well-received corporate earnings reports. And essentially, while the Dow Jones continues to hold above these two simple moving averages, it's likely the broader upward trend will continue. A move higher from here could see it target 36,000. Now, part of the reason why the US 30 pushed higher last night, closed higher last night, was because we did have some disappointing economic indicators out of the US. In the third quarter, it's reported that the US economy grew by only 2%, missing the 2.6% forecast. Keep in mind that 2% growth was a big step down from the 6.7% growth that was posted in the second quarter. Now, in the last decade or so, sometimes equity markets have reacted positively to bad news, as in bad news for the economy can often be good news for the stock market, because it would give the Federal Reserve a reason not to press ahead with tapering its bond buying scheme sooner than expected, or to indeed hike interest rates. So there's a view in the markets yesterday that the disappointing growth figures from the US actually helped push the Dow Jones higher. Now, why is the GDP figures important? Well, in the week ahead, on Wednesday, we will have the latest FOMC meeting. The Federal Reserve will announce their interest rate decision on Wednesday. No change is expected with regards to the actual interest rate itself, but this could be the meeting where the Federal Reserve announced the beginning of their tapering of the bond buying scheme. Now, the Federal Reserve at the most recent meeting suggested they would look to taper their bond buying scheme in the next few months, but they will only do it when they feel the US economy has been growing at a respectable rate. And people are now wondering if the last two non-farm payrolls reports, the headline figures have been very disappointing. Yesterday's GDP numbers were disappointing. People are now wondering, is that enough for the Federal Reserve to press ahead with its plans to taper as of potentially from mid-November? There's also top speculation the tapering might begin in December, or maybe even in the first quarter of 2022. This is going to be the focus of the week ahead. Speaking of non-farm payrolls, we also have the latest non-farm payrolls report coming out on Friday. This is going to be posted 2 days after the FOMC meeting, so it's possible the Federal Reserve might not act in relation to tapering until the Friday's jobs numbers are posted, and then potentially look to do tapering, be it later on in this year or in early next year. Now, in relation to non-farm payrolls, it's worth noting the last two headline readings of non-farm payrolls were very disappointing. The most recent update showed that only 194,000 jobs were created, well below the 490,000 that was expected. It is also worth pointing out that the unemployment rate fell to 4.8%, its lowest reading since the pandemic set in. So overall, it was a bit of a mixed bag, and this is also adding to the kind of the questions of when will the Federal Reserve look to taper? Are the Federal Reserve going to focus on the unemployment rate, which is falling, or are they going to be more fixated on the very disappointing headline readings? Not only do we have an update from the Federal Reserve next week, we also have an update from the Bank of England. Now, in the last few weeks, the Bank of England have become a little more hawkish in their language. We've heard from Michael Saunders earlier this month of the Bank of England, who said that the financial markets were right to price in a sooner than expected rate hike from the Bank of England. In the last few weeks, Andrew Bailey, the head of the Bank of England, said that high inflation rates in the UK is currently at 3.1%, well above the Bank of England's 2% target. Mr. Bailey said that in high inflation in the UK, the Bank of England needs to take action to tackle the high inflation. There's a lot of speculation that the Bank of England might look to hike interest rates in 2021, so either this meeting or the next meeting. And with that, we've seen a broad push higher in in GBPUSD. We can see here that in early October, the currency pair rose to its highest level since mid-September. Since then, we have seen a bit of a move to the downside, but in the last few sessions, broadly down to an overall weakness in the US dollar. We have seen the GBPUSD move higher yet again. It's back above all three moving averages. While it continues to hold above those three moving averages, it's likely that the more medium-term upward trend will continue. Moving higher from here, we could look to retest the 1.3833 mark, and a break beyond that could target this zone here at 1.3912. If we do see a move to the downside, support could be found from this zone here at 1.3707, and a move below that could target this region here at 1.3666. So once again, looking ahead to next week with the Federal Reserve meeting on Wednesday, with the Bank of England meeting on Thursday, and the US non-farm payrolls report on Friday, it's likely we could see volatility in not only the major indices such as the US30, but also the currency markets as well. So keep an eye out for potentially high volatility in GBP USD. That's all from me for this video. Thank you very much.